This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, August 5, 2026, and this is the After Hours session. Now, let's get into it. The S&P 500 touched $771.33, a level that signals fresh dominance for large-cap technology. Yet beneath the surface, the market is fracturing. While the broad indices climb, individual AI names are getting carved up, creating a split narrative that demands our attention right now. We are looking at the Wednesday, August 5, 2026 close. Let's walk through the data. The S&P 500 ETF, SPY, settled at $771.33, gaining 1.8% on the day. The Nasdaq 100, QQQ, led the charge with a 3.4% jump to $723.85. But look at the breadth. The Dow Jones Diamonds climbed 1.73% to $540.43, while the small-cap Russell 2000, IWM, held at $301.71, up 1.85%. Inside the sector buckets, the technology sector, exploded 4.98%, while utilities, the utilities sector, and the healthcare sector, were in the red. The SIBO Volatility Index, VIX, sat quietly at 15.86. On the fundamentals side, Shopify rallied 21.9% on 3 times normal volume, validating the AI commerce thesis. Eli Lilly added 4.8%, offering a non-tech anchor. Conversely, CDW crashed 15.1% and AMD fell 7.5% despite mixed earnings results. Meanwhile, the micro-cap speculators saw Amex surge 434% and EMD jump 427%. Macro headwinds remain. The 10-year Treasury yield is 4.63%, the 2-year is 4.2%, and the spread is flat at plus 0.43 percentage points. Inflation data from June shows CPI at 3.46% year-over-year and core PCE at 3.29%, both sitting well above the Federal Reserve's 2% target. Pulse, let's start with you. The VIX is at 15.86. That is deep inside the complacency zone. Given the double-digit crashes in CDW and the volatility in AMD, is this low volatility justified? It's absolutely unjustified. We are seeing a classic complacency-induced fragility. The VIX at 15.86 is at the very bottom of its recent 5-day range, which ran from 15.54 to 20.88. When you combine that suppression with a 1.8% gain in SPY, you are telling me that institutional flows are prioritizing momentum over protection. They are ignoring the fact that key AI-adjacent names like AMD and CDW are being punished hard. The market is pricing in a soft landing for tech while ignoring the hard landing risk for earnings misses. It's a dangerous disconnect. So you're seeing aggression in the flow, but fear in the specifics? Grid, let's look at the charts. SPY is at $771.33. It closed near its 5-day high of $773.41. Is this a confirmed breakout, or are we pushing into resistance?
Technically, the structure is bullish, but it is hanging by a thread. SPY is just $2.08 away from that intraday high of $773.41. A daily close above that level would confirm a breakout from the consolidation zone defined by the 10-day range of $729.10 to $773.41. However, look at QQQ. It's at $723.85, pressing against its own 10-day high of $725.66. The momentum is there, but the support band is thin. If SPY rejects at $773.41, we aren't going to a new all-time high. We are going to revert to the mean at $760.52, which was the low of the day. The technicals are screaming breakout, but the volume profile suggests it might be a distribution phase.
CIPHER, let's dig into the fundamentals. The technology sector is up 4.98%. Shopify is up 21.9%. but CDW is down 15.1% and AMD is down 7.5%. What is happening in the earnings quality here?
This is a ruthless purge of narrative-only growth. We are seeing a bifurcation where only pure-play AI monetizers are rewarded. Shopify jumped 21.9% on 3 times normal volume because it has verified revenue traction from AI commerce. Arista Networks is up 10.7% because it is building the physical infrastructure for this shift. But CDW, it reported earnings, yet it got crushed 15.1%. AMD dropped 7.5%. The market is saying that good enough earnings no longer suffice. If you don't have direct AI monetization clarity, you are being liquidated. It's not just a sell the news event, it's a fundamental reassessment of value. Capital is abandoning generalist tech plays and running to the winners.
SPECTER, you've been quiet. The macro data is flashing warning lights. The yield curve is flat, inflation is sticky. How does this sit with the current equity run-up?
It sits uneasily. We are watching equities price in a soft landing while the macro ledger screams stagflationary trap. Look at the 10-year, 2-year spread. It is flat at plus 0.43 percentage points. Historically, curves this flat precede recessions. Here, it means long-end yields are rising due to inflation fears, not growth optimism. Meanwhile, CPI is at 3.46% and core PCE is at 3.29%. That is nearly double the Fed's 2% target. With the Fed funds rate at 3.63%, there is zero room for aggressive easing. Yet, the technology sector has surged 4.98% this week. Investors are completely ignoring the cost of capital headwind. The foundation for this equity run-up is structurally unsound. The low VIX at 15.86 is masking the fact that we are in a no-man's land where central banks cannot support further multiple expansion without triggering hyperinflationary responses.
Apex tie this together. We have technical breakout proximity, fundamental purging, and macro stagnation. Where does the risk lie?
The risk is concentration. As Pulse noted, the VIX at 15.86 suggests traders are under-hedging, but SPECTER points out that the yield curve at plus 0.43 percentage points offers no cushion. CIPHER showed us that only Shopify and Arista are holding up, while CDW and AMD are collapsing. This means the entire SPY gain of 1.8% is being carried by a handful of names. If the AI narrative fails to expand beyond those top performers, we are looking at a severe mean reversion event. The market is technically valid but fundamentally narrow.
Let's pivot to the sector rotation. The technology sector is the clear leader at 4.98%, but look at the losers. The utilities sector is down 0.56% today, down 3.1% for the week. The healthcare sector is down 0.9% today, down 3.9% for the week. Grid, how are the charts treating these defensive sectors compared to the tech leaders?
The contrast is stark. On the tech side, the technology sector is pushing through resistance, but look at the defensive hedges. The utility sector and the healthcare sector are sliding off their short-term supports. There is no bounce in utilities. The capital flight is directional. Money isn't just rotating into tech, it is actively exiting defensives. That is a pure risk-on signal, albeit a fragile one. If the technology sector stalls at $773.41, we won't see money flow back into the healthcare sector. We'll see it dry up entirely, leaving those sectors vulnerable to broader market corrections.
CIPHER, does this sector rotation make sense fundamentally? Why are capital markets abandoning healthcare and utilities?
Because the market is obsessed with efficiency and scale. Utilities and healthcare are viewed as slow-growth, high-cost environments in a high-interest rate world. With the 10-year yield at 4.63%, those dividend-heavy sectors are mathematically unattractive compared to the explosive potential of AI infrastructure. ShopFee's 21.9% move proves that investors want speed. They want the 3x volume spike. They don't want the steady, regulated return of a utility company. This is a growth at any cost environment, masked as quality growth.
Pulse, is the crowd buying this? Are they still greedy, or are they starting to hesitate on these rotation trades? They are aggressively greedy. which is the problem. The surge in microcaps tells you everything. Amex is up 434%. EMD is up 427%. When you see double-digit percentage gains in sub-minus $100 float stocks, it means institutional capital has fled stability. They are hunting for lottery tickets. That is a late-cycle greed signal. The VIX at 15.86 confirms that nobody is worried about the big names failing. They are too busy chasing the microcaps. It's a euphoria phase that usually precedes a sharp correction when the liquidity dries up.
SPECTER, let's talk about those microcaps. Amex and EMD are up hundreds of %. Is this innovation, or is this a risk flag?
It is a massive risk flag. This is speculative overflow. When the majors like SPY and QQQ start hitting resistance, smart money doesn't disappear. It migrates to the most volatile assets possible. These microcaps have no fundamentals. They have no earnings. They have volume. This is the definition of a bubble in the making. And SPECTER warns you, when the VIX snaps back up from 15.86, these names will vanish overnight. The flat yield curve means credit is tight. Once the easy money stops flowing into these speculative vehicles, there will be no buyers left. The decay will be vertical.
Apex summarized the microcap frenzy. Is it worth tracking, or is it noise?
It is noise, but dangerous noise. Pulse identified it as a greed signal, and SPECTER correctly labeled it a liquidity trap. The fact that these names are moving 400% while the technology sector moves 5% shows that risk tolerance is distorted. You track it only to know when the mainstream market is peaking. If microcaps are surging while the S&P 500 is grinding upward, the market is tarping. Keep your hands off until the dust settles.
Let's look at the QQQ specifically. It's at $723.85, up 3.4%. Grid, what are the key levels for the NASDAQ 100?
The key level is $725.66, which is the 10-day high. QQQ is currently $723.85, so it is hovering just underneath. If it closes above $725.66, we confirm the breakout. If it rejects, we drop back to the $707.53 support level, which was the low of the day. The momentum is currently validating the breakout, but remember, QQQ is heavily weighted. One or two megacaps slipping can drag the whole index down. The technicals are aligned with the bulls, but the volume needs to expand to hold this level.
CIPHER, who is driving the QQQ weight. Is it broad-based, or is it NVIDIA and Microsoft doing the heavy lifting?
It is concentrated. The data shows that the technology sector is up 4.98%, which is dragging QQQ along. But inside the technology sector, the winners are Shopify and Arista. The losers are AMD and CDW, so the QQQ move is not broad-based buying. It is a winners-take-all scenario. The index is climbing because the top tier is accelerating, while the middle tier is collapsing. This makes the QQQ chart deceptive. It looks strong, but the underlying asset quality is diverging. The support at $707.53 is fragile because it relies on the continued success of the top 5 names.
Pulse, does the QQQ strength feel convincing to the sentiment sensors?
Not really. It feels forced. The VIX at 15.86 suggests calm, but the intrastock volatility is extreme. You have AMD down 7.5% and CDW down 15.1% on the same day. The index is up 3.4%. That is a contradiction. Smart money is using the index strength to exit weaker positions. They are selling into the QQQ rally. That is a classic distribution pattern. The sentiment is not buy the dip. It is sell the strength.
SPECTER, what happens if QQQ hits $725.66 and turns? Does the macro environment allow for a deeper correction?
Yes, if QQQ rejects $725.66, we will see panic selling. The reason is simple. The 10-year yield is at 4.63%. Growth stocks are discounted cash flow models. When the discount rate rises or stays high, valuations compress. We are already at 3.46% CPI. There is no room for error. If QQQ rolls over, it won't be a gentle slide. It will be a repricing event. The low VIX means everyone is naked. When the pain starts, there is no hedge to absorb the shock. Expect a move back to $700 quickly.
Apex, final thoughts on QQQ. Is the $725.66 level a buy or a sell?
It is a watch and wait level. Grid sees the breakout potential, but SPECTER and Pulse highlight the structural weakness. If QQQ breaks $725.66 on low volume, it is a bull trap. If it breaks on high volume, it is genuine strength. But given that the broader economy is growing at 1.5% annualized, I doubt we have the fuel for a sustainable breakout. Treat $725.66 as a resistance barrier, not a launchpad.
Let's wrap with the S&P 500 proxy, SPY. It is at $771.33. Grid, last look at the structure.
SPY is testing $773.41. The break is imminent or it is fake. The 5-day range is $729.10 to $773.41. We are at the top. If we close above $773.41, we open the door to new highs. If we fail, we fall to $760.52. The chart is clean. The path of least resistance appears to be up, provided the volume holds.
CIPHER is the fundamental case for SPY at $771.33 solid.
It is hollow. SPY is a basket of 500 companies. Half of them are stagnant or declining. The gain comes from the top 10%. This is not a healthy market advance. It is a luxury good. If the AI narrative stumbles, SPY has no second layer to catch the ball. The $760.52 support is built on sand. I am uncomfortable holding this level.
Pulse, how does the crowd feel about SPY at $771? Euphoric, but fragile. The VIX at 15.86 is the tell. Everyone thinks the party is safe. That is exactly when the music stops. The breadth divergence, where SPY goes up and CDW goes down, is the crack in the dam. I expect a sharp reversal if SPY touches $773.41 and gets rejected. SPECTER, give us the worst-case scenario for SPY.
The worst case is a liquidity crunch. With the yield curve flat at plus 0.43 percentage points, credit markets are stressed. If a major holder of SPY constituents needs to raise cash, they will sell SPY first. Since there is no volatility buffer, the VIX is at 15.86. There will be no buyers. We could see a 5% drawdown in SPY within 48 hours if a black swan hits the AI sector. The current price of $771.33 is a mirage of stability.
Apex synthesize the SPY outlook. Buy, sell, or hold?
Hold but reduce exposure. Grid notes the technical proximity to $773.41, but CIPHER and SPECTER warn of fundamental and macro fragility. Pulse confirms the sentiment is overly optimistic. The smart play is not to chase the breakout, but to wait for the pullback to $760.52. If SPY holds there, we revisit. If it breaks below, we are in trouble. Do not marry the position at $771.33.
That brings us to the close for today. Key takeaways. The S&P 500 is testing resistance at $773.41, driven almost entirely by a narrow band of AI leaders. The VIX is dangerously low at 15.86, masking significant breadth divergence. Earnings quality is splitting the market, rewarding Shopify and Arista while punishing CDW and AMD. The yield curve remains flat at plus 0.43 percentage points, limiting Fed flexibility. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.